If I tear this note into two pieces, rip it in the middle, would it still have any value? You might say, who would take it? From your perspective, once it's in two pieces, it has no value. Similarly, people lose their capital in trading and then feel that recovering from the loss is impossible. But if I tell you that instead of two, the note is in three pieces, and you have all three pieces, you can go to the bank and deposit it according to RBI norms. Yet, many people don't know this and regret it. Similarly, in this video, I'm going to tell you things that many people don't even know about how to recover a loss. So watch the video till the end because we'll cover all the steps that will help you recover your loss as soon as possible. You already know that in trading, SEBI data shows that 9 out of 10 people incur losses. The difference isn't in the strategy, it's in discipline, risk management, and self-awareness. An amateur trader trades on hope, but a professional trader tracks, tweaks, and treats trading like a business, not gambling. In business, expenses can become losses, but revenue becomes profit. In this video, we're going to talk about trading secrets that you should follow if you want to cover your losses. First, let's talk about the trading journal. Look at any athlete. You've seen movies where boxers prepare for fights. Before a fight, they watch their opponent to understand their style. They even review their own footage repeatedly to see their mistakes. Professional traders realize that tracking their own performance is just as important as it is for an Olympic athlete. You cannot trade blindly. Journaling gives you honest feedback. It helps identify blind spots and gives you a sharp edge to be profitable in trading. So, what goes into a trading journal? A trading journal is not just a profit-loss statement where you write the date, today's profit, today's loss. It's much more. There are 5 important things in a trading journal. Trade details: enter which stock or asset you traded, the index name, date, entry price, position size, number of shares, and stop loss. This data forms the foundation for your trading setup. Setup reasoning: why did you take the trade? Was it a breakout, pullback, or reversal? Trading without reason might feel interesting but is not profitable. Market context: what was the overall market trend? Were there any catalysts like Fed meetings, budgets, or earnings reports? Context determines whether your strategy failed or the market condition was just unfavorable. Emotions and execution: how confident were you on a scale of 1 to 10 when entering the trade? Did you follow the rules or enter out of FOMO, fear of missing out? Take screenshots of big profits or losses because memory is unreliable. Tracking and analysis: maintain this journal either in Google Sheets or a physical notebook. Track how many trades you take each day. Simple steps, just 5 minutes a day, can help you identify patterns in your mistakes and start your profitability journey. Now let's talk about the mathematics of drawdown. In trading, one of the most dangerous concepts is a drawdown. What does that mean? Drawdown is the drop from a high to a low in your trading account. The math behind drawdowns is non-linear, not straightforward. This means the bigger your loss, the disproportionately more time it will take to recover. It becomes harder the larger the loss. This is called asymmetric recovery in trading psychology. Here's an example: if you lose 50% of your capital, you need a 100% gain just to break even. Practically, this is almost impossible. That's why capital preservation comes first. You must understand that recovering lost money is not about doubling it quickly, it's about protecting what you have. There's also the triple finance rule. Researchers Bell and Lopez de Prado found that the time it takes to recover from a drawdown is 2 to 3 times longer than the time it took to incur the drawdown. For example, if a loss happened in 1 month, recovery might take 3 months. Professional traders stay calm, amateurs panic. Panic trading leads to revenge trades. You see a loss, and your brain says, "I need it back now." This is how many traders wipe out their accounts. Trading is 80% psychology and 20% strategy. Our brains are not wired to make probabilistic decisions reliably, they react biologically to stress. Here are 5 emotional traps you must understand. Greed and FOMO, fear of missing out: when you see a price rising, your dopamine hits, and you jump in at the peak. Always wait for confirmation. Use at least 2 independent confirmations before entering any trade. Loss aversion bias. The pain of losing is twice as strong as the pleasure of gaining. Traders hold losing positions hoping they will recover, while cutting winners too early. Revenge trading. After a loss, many try to immediately recover by taking risky trades. This is a silent account killer. Overconfidence. After a few wins, traders feel they've cracked the market and ignore risk. This often leads to big losses. Confirmation bias. Traders only read news or reports that support their existing trades. Always seek information that challenges your assumptions to understand real risk. Understanding these traps will help you become a disciplined, profitable trader. Financial mistakes in trading mostly come from poor risk management. One key rule is position sizing. Position size equals capital times risk percentage divided by entry price minus stop loss price. This formula ensures that your loss per trade is fixed, regardless of volatility. Example. Capital, $50,000. Risk per trade, 5% $2,500. Entry price, $100. Stop loss, $80. Position size equals $2,500 divided by $100 minus $80 equals 125 shares. This method prevents panic during trades. Your losses are controlled, even if the market is volatile. Next, understand the risk-to-reward ratio. Always take trades with potential profit at least 3 times your risk, 1-to-3 ratio. Even with a 40 to 50% win rate, maintaining proper risk-reward ensures long-term profitability. Finally, implement adaptive recovery and auditing. When in a drawdown, switch from offensive mode to defensive mode. Reduce trade size until confidence returns. Never take full positions immediately. Audit your trading journal regularly. Identify good losses, trades following strategy, versus bad losses, rule violations. Re-enter gradually as confidence rebuilds. Analyze weekly or monthly. Gross profit divided by gross loss. Win rate. Equity curve, smooth upward trend equals disciplined trading. Discipline ensures that trading is like a marathon, not a sprint. Small, controlled losses are okay. Avoid large, emotional losses. A loss in trading does not mean you should quit the stock market. Think of it like standing on the crease in cricket. If the ball doesn't hit your wicket today, tomorrow you might score a boundary. Long-term investing tips. Focus on ETFs, exchange-traded funds, instead of a single stock. ETFs diversify your capital across multiple stocks, similar to mutual funds, but often with lower fees. You can invest through SIPs, systematic investment plans, or pledge money to trade long-term. To invest in ETFs or start SIPs, you need a Demat account. Free account links are provided in the description and pinned comment. Automation workshops. Every month, a 5-day live workshop teaches trading automation. For crypto traders, you learn how to automate trades. Losses are cut automatically. Profits are booked automatically. You don't need coding skills to automate your strategy. Automation ensures risk management rules are followed without emotional interference. How to participate. Links for Demat account and Razorpay registration are in the description. Seats are limited. Live batches allow one-on-one discussions only to a small group. Workshops run 8 p.m. to 10 p.m. Dates change monthly. Check Razorpay link. By mastering ETFs, long-term investment, and automation, you protect your capital and reduce emotional trading. Final advice. Share this video with friends who trade. Subscribe and click the bell icon for more trading content. Remember, your trading account reflects your mindset. Disciplined mind growing account. Confused mind market can blow up your capital. Let's summarize what we learned in this video. Maintain a trading journal. It's your roadmap, just like an athlete tracking performance. Understand drawdown mathematics. Prioritize capital preservation. Identify psychological traps, FOMO, revenge trading, overconfidence, confirmation bias. Learn how to recognize them and avoid unnecessary losses. Set loss limits. Always know how much capital you are willing to risk per trade. Mindset reflects in your trading account. Disciplined mindset, consistent growth. Undisciplined mindset, account at risk. Actionable advice. Share this video with your trading friends. Subscribe to the channel and click the bell icon for updates. Comment if you want more trading videos or strategies. Remember, trading is a marathon, not a sprint. Small losses are acceptable if you manage your risk and control your emotions. Long-term strategy, journaling, and automation are key to becoming a profitable trader. Be self-made, stay disciplined, and grow your capital wisely.